Okay, so you want to own an oil refinery. Not a gas station, not an oil well. The refinery, the part of the business most people can't even picture sitting between the crude coming out of the ground and the gasoline going into your car. It looks like the safest, most boring business in the world. Steady demand, essential product, government protection built in because no country wants to run out of fuel. Here's the problem. Some of the biggest refineries in America have shut their doors in the last 5 years. Not because the world stopped needing fuel, but because the refinery itself stopped making sense as a business. Meanwhile, a handful of owners are quietly pulling in billions from the exact same asset class. Same crude oil going in, same gasoline coming out. Completely different outcome. By the end of this video, you'll understand exactly why. The real economics underneath the refinery business. The ones that decide whether you end up owning a money machine or a stranded, multi-billion-dollar liability. Here's the part most people get wrong before they've even started. They think the challenge of owning a refinery is running it. It isn't. The challenge is affording it in the first place. A large-scale refinery, the kind that can actually compete, costs somewhere between $8 and $15 billion to build from scratch, depending on size and complexity. Reliance Industries spent roughly $6 billion building the original Jamnagar refinery in India in the late 1990s, then spent billions more expanding it into the largest refining complex on Earth. That's the entry fee, not the good version of the business, just entry. And unlike a hotel or a shopping mall, you can't build it in phases and start collecting revenue early. A half-finished refinery produces nothing. Every dollar of that capital sits idle until the entire interconnected system, the distillation units, the cracking units, the pipelines, the storage, is complete and running together. You don't get partial revenue for partial construction. You get zero, right up until the day you get everything. This is why almost nobody builds a new refinery anymore. The last major greenfield refinery built in the United States went online in 1976. Every refinery operating in the country today is a decades-old asset, expanded and modified piece by piece, because the alternative, starting from nothing, doesn't survive the math. The land is cheap by comparison. The permits, the pipelines, and the sheer physical scale of the equipment are where the real money disappears. Nobody gets into the refinery business by accident. You get into it with a war chest, or you don't get in at all. Now we get to the question that actually matters. Once you spend your billions and the refinery is running, how does it make money? Here's the part that breaks people's brains. A refinery doesn't profit from the price of oil going up or down. It profits from the gap between two prices moving apart. That gap has a name, the crack spread. You buy a barrel of crude oil. You crack it apart through heat and pressure into gasoline, diesel, and jet fuel. Then you sell those refined products separately at their own market prices. The crack spread is simply the difference between what you paid for the crude and what you collected for everything you made from it. If crude oil is $80 a barrel, and the gasoline, diesel, and other products you refine from that barrel sell for a combined $95, your crack spread is $15. That $15, multiplied by however many hundreds of thousands of barrels you process a day, is your gross margin before a single other cost is paid. And this is why refinery owners often don't care whether oil prices are high or low. They care whether the spread is wide or narrow. Oil at $40 a barrel with a wide spread beats oil at $100 a barrel with a narrow one every single time. Most outsiders watch the price of crude and think that's the story. It isn't. The story is the gap. The oil price is the headline. The spread is the business. So if the spread is what matters, the next question writes itself. What decides how wide your spread can get? The answer is complexity, specifically, how much of that crude barrel you can convert into the expensive stuff instead of the cheap stuff. Every barrel of crude oil that comes out of the ground contains a mix of heavy, low-value components and light, high-value components. A simple refinery can only pull the easy fractions, the parts that were already close to being gasoline or diesel. A complex refinery, built with additional cracking and coking units, can take the heavy, low-value residue that a simple refinery would throw away and convert it into high-value fuel too. First, this means your feedstock costs less. Second, it means your competitors running simpler equipment are locked out of buying that cheaper crude at all because they can't process it. Third, it means your spread widens from both directions at once. Cheaper inputs, same valuable outputs. Complexity isn't a technical detail buried in an engineering report. It's the entire reason two refineries buying the same crude on the same day end up with completely different profit margins. So, if you're the kind of person who wants to actually understand how businesses like this work underneath the surface instead of just watching the headlines, that's exactly what this channel does every week. Subscribe so the next one lands in front of you. Here's what the spread doesn't tell you. A wide crack spread looks like pure profit on paper. It isn't, because a refinery has two enormous costs that never show up until you're already the owner. First, the turnaround. Every 4 to 5 years, a refinery has to shut down entirely. Not for a day, but for weeks to inspect, repair, and rebuild the equipment that's been running non-stop under extreme heat and pressure. A major turnaround at a large refinery can cost $50 to $100 million, and during that shutdown, you're producing nothing while still paying your workforce, your debt. A refinery that looks profitable on the crack spread alone can still be losing money the moment you add in what it costs just to keep the doors open. Of all the numbers in this business, one matters more than any other: utilization rate, the percentage of your total capacity you're actually running at any given time. Here's why it's the number that decides everything else. Your fixed costs, the debt on that $10 billion facility, the maintenance staff, the insurance, the base workforce, don't move whether you're running at 60% capacity or 95%. But your revenue moves enormously. A refinery running at 95% utilization is spreading those fixed costs across almost double the output of one running at 60%, which means its true cost per barrel is dramatically lower, even with an identical crack spread. This is why refinery owners obsess over keeping utilization high, even when it means selling product at a razor-thin margin during weak periods. Idle capacity isn't neutral. It's actively destructive, because the fixed costs keep accruing whether or not you're refining a single barrel. It's also why refinery closures cluster the way they do. When a facility can't maintain a high enough utilization rate, because it's older, less complex, or poorly located relative to pipelines, the fixed costs eventually overwhelm even a healthy crack spread. The refinery doesn't fail because the market turned against fuel. It fails because it couldn't keep the lights on efficiently enough to cover what it costs just to exist. The crack spread tells you if the business can be profitable. The utilization rate tells you if it actually will be. This is the part that explains something most people never see coming: refineries that were making money the year before they closed. Between 2019 and 2021, several major U.S. refineries, including large facilities on the East and West Coasts, shut down permanently. Not because they were in bankruptcy, because the owners ran the long-term math and realized that the capital required for the next turnaround, combined with tightening environmental costs and a structurally low utilization rate, meant the refinery would never again be worth what it cost to keep running. A refinery isn't judged on last year's crack spread. It's judged on whether the next 20 years of turnarounds, compliance costs, and competition against more complex facilities still add up to a positive return on that enormous sunk capital cost. The moment that math turns negative, even while the facility is still technically making money today, a rational owner starts planning to shut down, not the next expansion. This is the trap that catches outside investors constantly. They see a healthy income statement and assume the asset is healthy. They don't see the aging equipment, the looming turnaround bill, or the complexity gap against newer competitors. The things that determine whether this year's profit is the last good year or the first of many. The income statement tells you what happened. It never tells you what's coming. Look at the owners who built real fortunes on this exact asset, and the pattern is identical every time. Mukesh Ambani didn't just build a refinery in Jamnagar. He built the most complex refining facility on the planet, specifically so Reliance could buy cheap, heavy, difficult crude that competitors couldn't touch, and converted into export-grade fuel sold across Asia, Europe, and the U.S. Coke industries. Under Charles Koch, took the same approach with its U.S. refineries, investing heavily in complexity upgrades decades before it became an industry standard, so their facilities kept winning the feedstock game long after simpler competitors had been squeezed out. Neither of them got rich because they predicted the price of oil. Nobody consistently does that. They got rich because they understood, before anyone else acted on it, that complexity, utilization, and cost discipline, not the price of crude, are what separate a refinery that compounds wealth for 40 years from one that gets shut down after 15.